few know how to structure a policy that gives you all of the benefits designed for future investing, which means that you've got to find the people out there that know how to do it. Now, I've only met 3 people in the last decade that know how to structure these in a way that really benefits you and I with our future investments. And what I've done is, if you click the link below, I'll give you immediate access to a list of the people that I work with, people I've worked with that I implicitly trust, that have your best interests at heart. Now,
So the reason for that is because, think about it, if you pass away, God forbid, you have your spouse or your partner or whoever else is going to raise those kids, you are basically acquiring your income that you would have made over that time span. So we said 20 years, right? But, you know, we're not accounting for saving it with interest and working on that compound interest that I always talk about. So yes, you can grow that nest egg, but you're really trying to compensate for your, obviously, deal to where it's essentially just a payday loan for the middle class. Versus term insurance, where you're actually renting the insurance. So you're paying every month, you have no money going into it, but God forbid, when that event does happen, when you eventually do pass away, you will be covered through that term amount. The rule of thumb is 10 to 12 times your actual gross income, but there are little nuances that this calculator helps visualize. So let's go through each one of these and pretend like we're going through an actual scenario.
Extend my arms of leverage. And how am I going to do that? I'm going to do that by accessing my whole life policy. I'm going to put it in my investment, give me an opportunity and potential for some higher returns, pick up dual benefits. My friends, for me, that is not only one of the most sophisticated approaches to real estate investment and business, but it picks up all these other benefits that you can't find anywhere else. Now, here's the downside. You could talk to anyone who sells life insurance, and they would love to sell you a term policy or a whole policy. But this type of policy is that you're guaranteed a 4% annual ROI. Now think about that for just a moment. My bank is giving me 0.1%. They're going to give me 4%? I got news for you. That is 40 times more money just with this first benefit alone. Why would they do that? Well, who cares why they do that? Let's just talk about why you need to do that. Have you heard of inflation? Did you know that right now it's clipping 7% and it's on the rise? Right now, what will I get if I choose to do that instead of putting money in the bank? And the very first one I have to ask you is this. Fine, put your money in the bank. What is the bank giving you? It seems a little bit like a stupid question, because we all know that the real answer is akin to nothing, no things. And the truth is, your bank might be giving you 0.1%, like 0.1%, or maybe it's 0.01%. But you see, the first benefit when you put your money into a CVDP, it becomes inevitable that you grow your wealth and you become more successful in life. And the fourth benefit that I'm about to share with you gets me really excited as a financial genius. And for your financial genius, check this out. Did you know that the fourth benefit is that your 4% guaranteed ROI return and your 1%, 2%, or 3% dividends, that total 5%, 6%, 7%, did you know that it grows tax-free?
Free and free and free.
Have you ever contemplated what would happen to you if instead of dying, you became disabled? Like literally, what would happen if I lost my voice, like throat cancer or something horrible like that? Or what would happen if I lost a limb? You know, there's a lot of people that if they become disabled, they lose their income. And so the seventh benefit that's kind of really cool about this policy is it says, if at any point you become disabled, there's insurance to make sure that your policy continues getting paid for even when you can't pay for it yourself. The better or the more positive the arbitrage. This whole life insurance thing I'm sharing with you, it's about stashing cash in a place where you can then intentionally borrow it and put it into business, real estate, other investments that make you more money. This is just a whole lot smarter than what a bank will ever give you. Okay, Chris, so let's just assume for a moment that I have some money, a little bit every month, that I'm getting ahead with, and instead of putting it in the normal bank, I want to put it in this life insurance policy. What are the 7 benefits? Not necessarily what's in your best interest. In fact, today's video, I'm going to show you how to rig the system so that you get banks at their own game and you start winning the game of money arbitrage. Money arbitrage? Chris, that word just went like right over my head. Listen, it's simple. Take an amount of money, and if you could invest it in something and have it literally give you the same amount back as a return, you doubled your money. That's arbitrage. You put something up and you got something back. And the more you get back, government insured will usually insure it up to $250,000. Here, what I love about this type of bank is that my money is entirely untouchable. What I mean by that is someone cannot litigate and access this money and actually pull it out of the account. It's yours, which I think is pretty awesome. The third benefit that I really love about this is that I can borrow my money out, and what I can do is I'm going to build what I call a tax shelter. The tax shelter means this. How much of the money that you get can you really depend on, and how much is variable? Like when you're a business owner, sometimes you get really big irregular amounts of money, but there's another amount of money that can dependably come in on a regular basis. The dependable money is what I like to put consistently in the policy. The irregular amounts, I might eventually get it in the policy, but because I can't really depend on them every month coming in, I don't want to set it up like clockwork to have it go in there. So the real answer is I put as much money in that policy as I possibly can. Last year, term, and the other is called whole. And whole life and term life are different from each other. Term is really cheap, and all you're doing is investing in your death benefit. Whether it's a good investment or not, yeah, if you have loved ones, that's an investment that will take care of them. Whole life insurance, what it does, it actually has a living benefit as opposed to just a death benefit, which means that you can get a benefit, not just your loved ones. You both can. Here's how whole life insurance policy works. Number one,
will your survivors need? So for this example, let's just say we do make $100,000 net, right? So now, how much money do we have in savings and investments? Let's say we have $30,000 liquid. Now, we did say that we have 2 children. So we have 2 children here. One is 3, one is 5 years old. And how much is needed for future college expenses per child? Let's say $100,000 for each kid. I know I'm going kind of high here, but who knows what college tuitions will be, 10, 15.
Every time I make a payment every month into building that account, that pit gets deeper and deeper and deeper. I can borrow the money, I can use it to invest, I can use it for business, I can use it for a number of things. And then when I pay the money back, my money gets to grow tax-free at that dividend rate. How cool is that? Like, that's huge. So based on this alone, when people ask this question, is life insurance an investment? How is it investment? Well, for me, it's an investment different than the way most are looking at it.
For example, for easy numbers, if you make $100,000 a year, you're going to need about $1 million to $1.2 million in life insurance. However, there are many factors that go into this calculation, so it makes sense to actually go through a life insurance calculator that I found online. So without further ado, let's get right into that calculator. So ultimately what we have here is how much money will be needed for certain things that come up during life depending on what age you pass away at. So how much money will be needed for burial expenses? So typically what I've seen the average is about $8,000 to $12,000 depending on how high end you want to go with the casket and the services and all that stuff. There's a lot of things that go into it. I actually worked for a startup company called efuneral.com, and we were actually bought out by a publicly traded company. So big shout out to Mike and Brian of eFuneral. I've called every single funeral home in Northeast Ohio, and I know them all by name. Passing away and your loss of an income for that family. So again, we mentioned $100,000 in this example. So this person is going to need right around $1.6 million to cover their earning potential over those 20 years. So this is a subject that no one really likes to talk about because everyone thinks they're going to live forever, but I've seen it in real life and it does happen to people and it freaking sucks. But at the end of the day, it's nice to know how much you need to cover, that way your spouse or your significant other. So I digress. So how many years of income will you need to cover? So let's say, for example, you're a new father. Let's say you're 35 years old, okay, and your kids were just born. Let's say they're 3 and 5 years old. So you need to cover, let's just say, at least through college. So let's just call it a nice even number, let's say 20 years, right? Your kids will be graduating at 23 and 25 years old, so hopefully, they'll be making an income at that point in life. So how much annual net income?
You probably got to be thinking right now, oh my gosh, this sounds too good to be true. Why would Chris make a video on this? Is he going to get something? Here's what I want you to understand. These policies, if you know where to go, you can get them set up entirely for free, as in at no cost to you. And there's a link below where you can talk to a buddy of mine and he'll help you do just that. Now listen, if you're a subscriber on my channel, you know that the purpose of being a subscriber is for me to awaken the financial genius in you. I'm teaching you these things because as you do them, as you implement them, or put it more in this investment so that it produces more cash flow. Listen, now your loved ones are taken care of because should you die prematurely, you've got the money that can pay off your businesses, pay off of any of your debts. You're not allowing them to inherit your liabilities. It's one thing to say, hey, there's a pile of money in the bank. It's another thing to say, hey, I was left with assets that are cash flow producing that make me money, but they don't come with the headache and the stress of debt. This seventh benefit, this final benefit, is really important. The death benefit, and then the rest of it is going to go towards building what's called cash value. And this is money that you can access from the policy if you set it up the right way. Here's some of the benefits. Oftentimes, with the banks that are out there that set up these policies, I call them banks because that's really what they are. This is you setting up your own personal bank. And those banks, guess what they're paying you? They're paying you 5%. Dude, what's your bank paying you? Probably a whole lot less. And a normal bank, if it is, when you put money every month into a life insurance policy, it's like a forced savings account, as if you will. A small portion will go towards your death benefit. Let's say that I have a death benefit of $300,000 if I were to die. And then let's also say that I'm building some cash value. I might have a payment of $400 a month or $200 a month or $100 a month or $3,000 a month or a lot more for some of you that are using this as a rapid wealth strategy. And a small percentage will go to
making it because I've seen it, and I've also sold insurance in the state of Ohio. So shout out to I will tell anyone that's trying to get into sales, they have their financial representative role. Do not take that internship. All they're doing is trying to get your contacts, and they're pimping you out to sell whole life insurance. What we're going to be talking about is term life insurance. So whole life insurance is when you're actually owning the policy, but there's so many different caveats that I'm not going to go into on this video.
money that they're leaving to their loved ones. So no one should be able to sue for that. Not even the government should literally be entitled to any of that money. So anything that you grow in here, it is literally untouchable. And that is at some point in your financial successful future going to become really, really important. You know, at some point you are going to shuffle off this mortal coil and you are going to die.
Because I'm gonna die!
And when you do want to leave your family something, right? Well, turns out that this policy, the sixth benefit there, but there's only one strategy that is the best when it comes to real asset protection. Did you know that the fifth benefit inside these CVDP policies is that all the money that's in it is completely protected? That means that not even the government can literally litigate and take money out of it. Why does that rule even exist? The government views your life insurance as a protected asset class. Their assumption is if this person dies, this is what you want to reference. It's called cash value dividend paying life insurance, or CVDP for short. And there's a really good chance that your brother-in-law is not going to know what that is, because this is not a policy that they're incentivized to share with you, because it's all about putting money in and then taking money back out so that you can invest it. Most people selling life insurance want you to put money in and they don't want you to touch it because they earn a really big commission if you don't, but that's maybe not
8 years from now. Now, is there any one-time expenses you wish to fund? Let's just say no and calculate. So based on these inputs, this calculator is coming up with roughly $1.6 million. So if we go back to that original estimate of 10 to 12 times your net income, we're getting at right around $1 to $1.2 million. This is actually being a little bit more conservative. So for this gentleman, I would take out a policy that is right around $1.6 million.
When I say that whole life insurance is a great investment, I don't mean in and of itself. I mean, because in and of itself I get a death benefit, I'm getting a dividend way bigger than I'm getting anywhere else. No one else can touch it. It's producing these awesome tax benefits, but I can pull it out, and guess what I can do? I can put it right into the game of real estate. And this is where it becomes extraordinary, because now I can layer my banking policy with life insurance, and I can layer it on top of my real estate, and the two of them combined are significant. I want you to think about that for just a moment here. Literally all those gains, anywhere else you go, your money grows, the government wants their piece. They want their taxes. Inside of here, guess what? This grows tax-free. And you know what? The more successful you become, the more important that benefit is. So one of the questions that people sometimes ask me is, Chris, how much money do you actually put in your cash value life insurance policy? And one of the things that I do is I ask them, whether you're just starting to get ahead or whether you've been in the financial game for a long time, the time to set up a whole life policy that supports your investments is now. The longer you have it, the better the advantage. And if you already have a life insurance policy, but it's not designed to give you this benefit, it is time to make a changeover. And the individuals in the link below can totally hook you up, help you out, and get you exactly where you need to go.
So very quickly, let me actually backtrack here. The reason I'm passionate about this is because I've seen in my own life, whether it's friends or family, people have passed away prematurely, and it's left certain situations and certain families in a crappy situation, to be honest with you. Obviously, between all the grieving and all the stuff that just happens when someone passes away, finances are going to be messed up if you're not prepared for that death. So I'm not making this video to be a Debbie Downer.
And what that really just means is you're a long-term thinker, you're looking at legacy, you want your family taken care of, and that one right there, that's just a final benefit that says, I'm gonna commit long-term to doing this. I'm gonna commit long-term to putting money into this, strategically pulling it out. I'm gonna grow my investments. This is the way that I grow my wealth. And I'm telling you, this is actually the way that I grow my wealth. Life insurance is a good investment. Let's find out. First of all, let's understand what it is. There are two types of life insurance. One is called tier. I broke record. I literally put twice as much in as I normally do. And that's because my business is growing, it's successful. And I love these 7 benefits that we've been talking about. We all hope for success, but I have to tell you, there's a burden. The more successful you become, the bigger the target can be on your back. Literally, you become wealthy and other people think, how can I take from that person? Because for them, that seems sometimes like the easier path. So at some point, you're gonna become really interested in protecting your assets. And there's a lot of different strategies out there. Up here on the board, let me show you this. Come here. So let's just say for a moment that I'm getting my guaranteed 4%. And let's just say that I'm also now getting, instead of just 1, 2, or 3%, let's just say that I'm getting a 2% dividend. Add that up. That's a total of 6%. Again, inflation is at 7%. We haven't quite knocked that down. But you know what? 6% is 60 times more money than what your bank is likely giving you. Now, the majority of the money that you put in this policy, you have the ability to take back out. That portion is called cash value. And the third benefit is that you can borrow the cash value from this policy and you could use it to do something stupid like buy a boat. I'm on a boat! I'm on a boat! You could also use it to do something really smart. Buy another asset, buy an investment, buy a property, buy a business, buy something that's gonna make you money. Now, why would you want to do that? Well, come around again. I want to show you this. Let's just making me a 25% ROI. Well, now I'm making 25% here, which is, by the way, over 20 years going to deliver 27 times more money than the stock market. So I'm killing it on my real estate deal. I'm still picking up an extra 3% in the policy. 25 and 3, I'm making 28%. So I love being able to take my money out of the bank and have it still earning 3% as if it was still in there. What bank would ever do that for you? The answer is no bank. Significantly bigger and way more successful than they would be apart. If you have learned the discipline of saving money, then you should be saving money this way instead of just putting it into a silly bank account. Because every dollar that you have here gives you benefits that no ordinary or normal bank could actually ever give you. And number 2, it's going to eventually be time for you to make your move. There's going to be an amazing deal, a business acquisition, a business that you want to start, a real estate deal, something where you're saying, it's time to get some super leverage. I need to check out my perspective. The world, first of all, says, hey, you're earning 5%. That's diversification. That's better than your savings account. That's probably not too different than your 401k and your IRA. So yeah, it's a good investment. This is where I want to challenge that. If all you're doing is earning 5% on your money, you're screwed. You're never going to be able to earn enough money for retirement to get where you want to go. Because 5% compounding over time, it is pathetic. You've got to start super young and you've got to be often committed for pull it out and I'm going to invest it. Some of it might be literally for like a sleep well at night account, right? Like my emergency fund. But some of that is I'm just stockpiling it for when I can be a down payment on that next property, or I'm going to buy that commercial lot, or I'm going to buy that business. So the money is just hanging tight. And as long as it's hanging tight, there's a dividend that this policy will give me. And that dividend is typically somewhere between 1, 2, and 3%. So I want you to think about that for just a moment. In fact, I'm just going to write 40 years, maybe 50 years. But I have the ability to pull this money out, and I have the ability to put it into business. I can put it into a number of other vehicles. For me, I dump that sucker right into real estate. Why? Because I can get my real estate to produce 20%, 25%. I can produce much bigger gains, and I'm doing that on properties I'm buying every single day of the week. 20% is bigger than 5%. In this scenario, you can combine them together and you can get the benefits of both of them. Now, whatever money you have in the bank, it is losing value at 7%, and the number is only growing, it's getting worse. This is a hedge against inflation, and I get it. It's not quite 7%, but it sure is a heck of a whole lot better than 0.1%. Think of a life insurance company kind of like a bank that simply just pays you more and gives you more benefits. The second benefit, they're actually going to give you a dividend based on what you put in there. So I told you that I'm putting money in because I'm going to strategically.
And also the children that you're leaving behind are raised properly, or at least to the best of their ability, and they get every opportunity to succeed in life.
This is the traditional definition of what life insurance is. We're not talking about that today. Today we're talking about something very different. We're talking about life insurance that has living benefits, and 7, as a matter of fact. Now, chances are that you have some brother-in-law that sells life insurance and you're like, oh man, I should tell them to watch this video, or I want to be able to talk to them about what Chris is sharing with me today. That is, it also provides your standard, typical, traditional death benefit. Now, this death benefit for me is not about, oh, I want to leave my family some money when I die. I'm using this for all the benefits of growing my wealth, growing my assets, growing my business. When I buy real estate, there's a part of the house that's paid off. There's a part that may not be. So you know what the life insurance can be used for if you die? This is your business plan to take care of your family so they can inherit your assets without the liabilities. Pay off that real estate, pay off that house. Or just assume for a moment that I can borrow at 3%. But do you remember what you're earning? Between the 4% guarantee and the dividend, let's just say that you're earning 6%. You're borrowing at 3%, you still have an additional 3% that you're earning on. You're literally earning 3% on whatever's in there while the money is borrowed and now earning you. And in my world, if I borrow and I put it, let's just say, into a real estate deal, and let's say that that deal is